During economic recessions, house prices go down. That's the status quo, and the driver is really simple. The majority of homes are bought for owner occupation, and therefore personal income is the most significant factor driving home prices, with something called lifestyle inflation, which again is the more common personal finance trait. The relationship is quite linear. As income goes up, the higher we pay for a house. Now, normally during a recession, jobs and income levels decline, which means people have less money and can't really afford to pay as much for a house. Take the great financial crisis of 2008, for example. The housing market was pummeled and many people found themselves in negative equity. The number of foreclosures were up and so on and so forth. And that wasn't the case in 2020. So let's sprinkle some facts, guys. Since 2020, we are living through the most severe recession since the Great Depression. Yep, it's worse than the financial crisis, but housing prices are at an all-time high. But why is that? Is the 2020 recession as bad as the 2008 crisis? So looking at quarterly data of US GDP here on an annualized basis, Q1 was down 3%, Q2 was down 38%, Q3 was up 30%. The numbers are extreme, and when you add them all up, we find that the US GDP is currently down 3.5% to where it was at the end of 2019. Now, being down 3.5% doesn't really seem too bad. It's not really a big deal, is it? Well, numbers need to be analyzed in relativity. I'm a scientist, so I know that, and we look at it in context. The peak and trough in the financial crisis was -4%. For context then, despite an almost 40% growth on an annualized basis in Q2 of 2020 and trillions of dollars being pumped into the economy, insane levels of fiscal stimulus, the US economy is roughly the same position it was during the worst of the financial crisis. 2008-2009 was the most severe recession since the Great Depression, and that is roughly where we are at today. Yet house prices are booming, all-time highs. Taking data from the St. Louis Federal Reserve for 12 months ending August 2020, US home prices themselves rose by about 5.6%. And during the financial crisis between January 2007 and February 2010, house prices declined by about 22%. Now, it is important to note that at this stage there can be a lag between the numbers, and that is because housing markets have a delayed reaction generally. So the foreclosures take time, layoffs take time, and property transactions take time as well. Despite that, for 2020 we haven't seen a slowdown and reversal in the trend. So no, instead we have seen the trend continue to rise. All a little bit odd, but is it actually, or is it all about income? Income is the biggest driver in house prices, and unlike the 2008 crisis, the 2020 recession has been supported with huge fiscal stimulus. At the height of the pandemic, government-enforced lockdown meant that much of the fiscal stimulus was actually replacing lost income from employment during the recession. Just think about that for a second, guys. So much money was being printed and so much was distributed that it shielded us from the worst impacts of the recession. It's absolutely the same in the UK with our furlough schemes. So even though we are in a recession more severe than the financial crisis, personal incomes have been protected, and actually we have spoken on other videos where personal balance sheets have also improved. And that is a great thing, guys. However, what the data and the story is not showing, and again, same in the UK, is that house price growth is determined by incomes of people who are in the market to buy a house. And this is where the disparity kind of arises. Lower incomes hit hardest in 2020. A San Fran Federal Reserve research note found that workers in the bottom quartile make up 50% of job losses during this current recession, and high income earners have had the least impact on their earnings. So the rationale would make sense, as those in gig economies or jobs that have disappeared during the lockdown would have suffered the most. Now, low income workers have the least impact on the demand for houses, as the tendency is to rent. Middle and higher income earners buy, and their incomes have been protected. Combine that with fiscal stimulus such as tax breaks for purchases, low interest rates, and you have a perfect setup for home buyers to enter the market and bid up home. And so the wealth gap widens. Now, this is where that peculiarity of this recession really is something we need to talk and know about. House prices do form a significant part of personal wealth. It tends to be the single largest asset on a homeowner's balance sheet. Stock markets are booming and high income earners have had their jobs protected and transition to working from home. So this does allow higher and middle income earners to firstly invest in property and stock markets and ride the rise, I suppose, whilst low income earners have not benefited rather from the asset rises across the market. Whilst the point for future policymakers, and not just the US but across the world, is that the recession has had a disproportionate impact on low income earners. Therefore, to spur and sort of continue that economic growth in a post-pandemic world would mean governments would need to focus their attention on spurring economic growth for those in lower income. It's the right thing to do, but also stabilizes the weaker areas of our economy. Now, I have a playlist which uses UK points to talk about how credit and financing has also been spurring on house market growth in the UK, and some predictions for 2021. You can check those out over here, and see you over there.